Hey everyone, my name is Dan and welcome to my channel where I share with you my perspective on investing. In this video, we're going to take it back to the basics. And this video is important especially if you're planning to invest in index funds or ETFs. Why? Well, let's find out. We'll be exploring how indices are made up and what kind of information they provide to you as an investor. And looking at how they're made up will mean that we'll touch on how they're actually calculated, which means there will be a little bit of maths, but I promise it won't be too overwhelming, okay? To start off, we'll first talk about the naming convention of an index. The name or abbreviation itself is pretty straightforward, but for most indices, there will be a number following the abbreviation, which isn't just a random number. Let's take one of the most popular indices, for example, the S&P 500. This index tracks 500 large companies listed in the US, and these companies have gone through a selection criteria in order to be listed as one of the 500. The committee responsible for the selection will take into account the company's market capitalization, liquidity, sector classification, company's financial viability, and more. So it isn't as simple as just picking the 500 largest companies by market cap. And as an investor, you should really try to understand what exactly these indices are tracking, simply because there are other indices, such as the S&P 400, which tracks companies with a mid-sized capitalization, and also the S&P 600, tracking small market cap companies. Sometimes it can be confusing, because not all indices follow the same set of rules. For example, the S&P 600 obviously does not track the 600 largest companies in the US. In most people's views, the S&P 500 is the most widely used and followed for the reason that it is the most representative of the US stock market out of all the S&P indices. However, for some indices, like the Dow Jones Industrial Average, there isn't a number following the name of that index. The Dow tracks only 30 large companies listed in the US and also has its own selection criteria. The Dow is just as popular as the S&P 500, but it has been criticized for not being representative of the US market, as it only has 30 companies. The other big difference is that the Dow Jones uses a different calculation method to the S&P 500, and this brings me to my second point. Most indices are calculated using the value weighted method, or market cap weighted method. This method basically uses the market capitalization of each company in the index to allocate their individual weightings. We know that the market cap of a company is the mathematical product of its outstanding shares and its current share price. So to get market cap, just multiply the number of outstanding shares by the current share price. Then we take the market cap of each company and divide it by the total market cap, which is all the companies added together, to get the weighting for each stock. This weighting basically represents how much of an influence it has on the index. So the logic is that the stocks with bigger market caps exert a greater influence on the index. In other words, it carries more weight. Let's check out the S&P 500 components, for example. Here we can see that the top 5 are tech companies, taking up more than 20% of the overall index. And this means a 1% increase in Intel, for example, will not be the same as a 1% increase in Microsoft, as Microsoft has about 5 times the weighting of Intel's. And if you think about it in real terms, this weighting kind of makes sense because larger companies employ more people, have higher output, productivity, and have more financial impact on the economy in general. This is probably the most common calculation method used by indices around the world. Some other examples: the Nasdaq Composite, FTSE 100, ASX 200, and NZX 50. On the other hand, there are indices that use the price-weighted method, like the Dow Jones and the Nikkei 225. The idea of this method is very different, and it's to have the weightings assigned based on the price of the stock. So the weighting for each stock is the price divided by the total price of all the stocks in that index. So naturally, the stocks with the higher prices will have more influence on the index. Kind of a weird method though, right? So in the example of Dow Jones, you can see that the stock with the highest price gets assigned the biggest weighting, Currently that stock is Apple, and if you look at the top 5 holdings, they account for almost 40% of the index. So is this the kind of diversification you want? So what about stock splits then? For every index, there's something called the divisor, which effectively determines the final calculation of the index. With a stock split, the divisor will also change, as the index will otherwise be skewed. Because the company hasn't really lost value, it just has more shares at a lower price after the split. And all these indices that use either of those methods have their own divisor to adjust for factors that may affect the index. This is just a way to keep the index neutral of external factors. Now, when you see those indices, index funds, or ETFs again, I hope they won't appear to you as just another index. There are so many of them out there, and sometimes it's a bit overwhelming trying to pick one without understanding the mechanics behind them. But we know that from a lot of past studies, whether you pick the Dow or the S&P 500, the returns seem to be more or less the same, over a long period of time of course. But we can't forget that no 2 years are the same, and so in the short term you may actually see one index lagging behind the other. So for example, at the end of 2019, Boeing was still the biggest component in the Dow, taking up around 8% of the index, despite attracting a lot of negativity around its 737 MAX aircrafts. This negativity was then worsened by the airline industry taking a massive hit because of the virus, and we all know how much the Dow plunged during this time. My point is, Boeing being the biggest component may have caused the Dow to drop more than expected, than if the biggest component was Apple instead. So if we look at the year-to-date chart comparing the S&P and the Dow, we see that the Dow is actually lagging a bit behind so far this year. And that is obviously one of the downsides of the Dow being a price-weighted index, that there is a greater reliance on the stocks with higher prices to drive the index. This just goes to show that it is important to understand where you're putting your money, rather than blindly picking an index that you think will just go up like the rest of the indices out there, and then getting confused as to why you're lagging behind the broader market. I'm not telling you that one index is definitely better than the other, but under different circumstances and situations, one may perform better than the other. Again, picking an index fund or an ETF will depend on your risk appetite and what kind of diversification is appropriate for your investment objectives. So the next time you want to invest in an index fund or an ETF, I'd encourage you to do some background research on how the fund is composed, what the top holdings are in the fund, and whether or not those stock holdings are prone to big changes in the future. Any questions, feel free to leave a comment down below and I'll reply to you as soon as I can. Thanks for watching and have a great day.